Hi guys, if you're new to the investing world and still not very sure or even comfortable with the notion of potentially losing a lot of your money, don't worry, you are not alone. Ask every investor out there and high chances most of them, including myself, have done our fair share of mistakes which resulted in us losing 4 to 5 and sometimes even 6 digits of our investment portfolio. And of course, we learn it the hard way. So in this video, I'm going to share with you 6 beginner investing mistakes that you could be making and why you should avoid making them so that you can save yourself from losing a big sum of money. So first things first, understand how much returns you are actually expecting. 5%, 10%, 15%, or you totally don't know. Why do I say so? Well, because logically speaking, it's just not realistic to expect quick and high returns on your investment, especially when fixed deposits (FDs) traditionally give us about 3 to 4% of return per annum, and that is risk-free, means no risk lah. So anything more than that, which is technically 5% and above, usually carries greater risk. Obviously, higher risk, higher reward. So let's say you invest in the S&P 500. Historically, they bring an annual return of 9 to 11% over the long run, and usually we would use that as a benchmark for our portfolio performance. But that does not mean that it will provide the same 11% every single year right after you put your money into it. And if it's that easy and things just go up and up and up all the time, then we all no need to work already, right? My point is, the market is full of ups and downs as well. Back then when I started investing, my dividend stocks, you know, those banks and REITs, were doing alright and I was profiting for quite some time. But then when the pandemic hit on March 2020, everything just came crashing down and my portfolio was down a good 30 to 40% right in a matter of weeks. And it did eventually recover over time as the economy recovers through quantitative easing, means printing money lah. But long story short, good investments usually go up over the long run. Not 100%, but you need to know that it's never a straight line up only. So just because the first 1 or 2 years of your investment is not quote-unquote profitable does not mean you have made a bad investment. I mean, yes, your timing could be better, but no one or no indicator or chart can really tell you when is the right or the best time to buy or to sell the stock. And the same goes the other way around. If for some reason the first year you get a shock 25% return, that does not mean it is a godlike investment. Things could eventually go south as well. So ultimately, it all, as I hate to say it, it depends on the asset you are investing in and what is their long-term prospect. And next, you must have heard of this advice before. To start investing, start with those well-established big companies, aka blue chip stocks, because they are more stable or sometimes more affordable. I mean, not to say it's wrong, but in my opinion, not all blue chip stocks are 100% safe, as every other competitor is also actively trying to surpass them. And at some point, when some companies grow big enough, they are making so much money already that they are not really incentivized to innovate anymore further. Don't get me wrong here, being big is not a problem. The lack of innovation is. So if one day a disruptive technology comes out, you may be surprised how easy an entire empire can fall. And if you are old enough, just like me, then you would have heard of Nokia, Kodak, or the TV industry as a whole. They were doing so great back then, but after pandemic, look where they are right now. Take Nokia as a case study. In the late 90s, they became the best-selling mobile phone brand in the world with $4 billion of operating profits. But then, when Apple introduced the iPhone in 2007 and disrupted the whole phone industry, Nokia's outdated phone simply stood no chance. And in just 6 years, Nokia's market value dropped by 90% and eventually was sold to Microsoft later on. And like what Nokia said, we didn't do anything wrong, but somehow we lost. Yes, they did nothing wrong, but vice versa, not doing anything right on top of the lack of vision and also innovation can kill just any company regardless of their size. So I wouldn't say that all blue chip stocks are 100% safe. Now, the third mistake for any beginner is to think that the future is all about tech companies only. And while yes, it is true that for the past decades, the tech companies, especially the big boys in the US like Apple, Tesla, Google, Microsoft, Nvidia, etc. have shown impressive growth. Just look at their 10 years annualized return. Apple 26%, Google 14%, Amazon 25%. Doesn't want a piece of that amazing return, right? But you need to be very aware that there's still a lot of tech companies, usually the younger ones that promises a lot of innovation and AI and all those fancy jargons. Many of them like Lyft, Peloton, Snap, Pinterest are still not profitable and rely on venture capital money or are in just huge debt just to stay afloat. And this is very dangerous because when the interest rates increases, the cost of borrowing also increases and those venture funds cannot simply give away money anymore. So just think about it, just how many of them can survive eventually. And well, tech is of course a very sexy and lucrative business to invest in. But the tech world updates so frequently and not everyone, including myself, can stay up to date with the latest tech news. So if you don't really want to take that risk, don't worry, there are still many options outside of the US tech sector pool. Just an example, some of the big brands for F&B, food and beverages industry, we have Starbucks, Coca-Cola and also McDonald's. You all know it, right? And under consumer staples, there are Walmart, Procter & Gamble, P&G and also Unilever. Or let's say banks. Some of the biggest banks in the US are Bank of America, Citibank, Wells Fargo, JP Morgan, Morgan Stanley, etc. They are all big names that have business presence worldwide, so you can always check them out too, rather than just confining yourself to the tech sector only. But hold on, if you're thinking to get your hands on say smaller, mid-cap or emerging stocks, they are probably not available on all your local stock exchanges. Here's where I like to introduce you to Interactive Brokers, a very well-reputable and well-regulated stockbroker in more than 10 different countries, including the US, UK, Singapore and so many more. They also come with an extremely cheap brokerage package of only 35 cents per trade in the US market. Pretty amazing, right? Feel free to use my links down below to open an Interactive Brokers account for yourself. Alright, let's continue. Now, the next mistake is to think that you are investing when you are actually trading. What do I mean by that? Well, when we just get started, it can be very tempting to make quick profits and trades based on intuition or just simple indicators. When you see your stocks profit $50, some of you might just straight away sell and then withdraw that money. And yes, sometimes it may yield some profitable results, but that is mostly short term only. The truth is, you cannot keep staring at your phone for the whole day, right? I mean, 1 or 2 weeks can lah, but you need to know that long-term and sustainable trading is a full-time job. And even if you decide that you have plenty of time to trade, do you know that 90% of traders actually lose money over the long run? And you need to know this. Yes, you can sell at a profit today, nothing wrong. But do you know when to enter again? And if you do, are you sure you can re-enter at a good price at a good time? I hope that gives you something to think about. So instead of buying and selling frequently, I personally would rather focus on long-term investments instead. If you have done your research well, short-term market fluctuations and bad headlines shouldn't affect your decision. And in fact, you should be bargain hunting for opportunities rather than be in panic or just fear. And sometimes the best strategy to counter the fluctuation is to literally hands off, do nothing. If you don't have the money to average down or buy more shares, turn off your brokerage app. Don't even see or don't even overreact when you know it is a short-term pain. And as cliche as it sounds, just bear with me, just let time do the justice for you. Now, if you think you have done enough homework on the companies that you plan to invest in or you invested in, then no need to understand much about the economy already, right? Well, The answer is no. Because you see, all companies you invest in are affected by the macro environment. How the country's economy is doing, is the industry a sunrise or sunset industry, or is the competition fierce? You need to take that all into account. And look, just to share something with you, when US President Joe Biden announced a big stimulus package back then, the price of raw building materials also increased. Why? Well, that's because the stimulus package is to improve the infrastructure in the US, and the demand for raw materials would also go up, right? Since everyone has the extra cash to renovate their home and stuff. So naturally, there'll be more construction activities happening. And ultimately, the companies that supply those materials would also profit from that decision. See, isn't it so useful to understand how the economy, politics, or market cycle work? And you will be able to perceive things differently from how a normal person would, where they would probably just complain all day about it. But you, as an investor, can ultimately benefit from what's happening in the market, or heck, even foresee and make an educated guess on what's going to happen. And to do all that, it all starts from understanding government policies and how the particular industry or even technology works. Last but not least, this might be an obvious one, but I think it's always worth reminding ourselves, even myself, about it, because it's timeless and people make this mistake again and again and again and again. Be mindful of not buying for the sake of trends. Remember GameStop, Palantir, Neo back then? When you see news and it's all about them, wow, grow another 30 or 50% in a span of weeks. Very tempting and FOMO, right? But the reality is, good things don't last forever, and someday they will eventually reach the peak and just start dropping, and you might just be Mary the Little Lamb buying right at the peak and become someone else's exit liquidity. And also, just because 5 or 10 YouTubers recommend the same stock ticker does not make it a good investment or good stock for your investment portfolio per se. You need to know that everyone is different financially and in a different stage of life, chasing different things, having different risk appetite. Those finance gurus may have more capital and can afford losing more money, but the same may not apply to you. So it's very important to understand what is your risk profile and not just copy their trades blindly. So there you have it, some thoughts that will hopefully help a little in your investment journey. Have you made any of these mistakes that I've mentioned earlier? Do comment down below so that we can all learn together. The usual disclaimer applies. These are just some of my personal sharing and should not be taken as an investment advice. You should ideally get financial advice from your mom and dad or even financial advisors. Definitely not from me. And if you would like to know what kind of investing strategy you should start with, conservatively or more aggressive, do check out my next video over here that helps you to match your strategy according to your age, your income, etc. See you over there.